on record immediately so that you can be able to look at it on on the video basically later so that you can understand what I'm saying. If in case you don't get it, you are able to rewatch it and understand it.
Yeah.
Now, what I simply said is this. This area is called a high, and this high constitutes of a bullish and a bearish candlestick. So these green candlesticks here, they are called bullish candlesticks, while the red ones are called bearish candlesticks. So a high is a point where you see a bullish candlestick and a bearish candlestick close at a significant point. It's a high. Now, this is on the higher time frame. This point is a high. You understand? This area is a high. This one is a high. This is also a high. This point is a high. Same as this. Same as this. Now let's take go a little bit on the chart. Good. So we have this area also. This point is a high. Also a high. This is a high, just like that. Now all these significant points are highs. But one way I can simply explain to you can use to understand a high is basically a point where you have a bullish and a bearish candlestick at the same resistance point. Not really resistance, just at the top. Because resistance, actually, if I should say resistance, that is a different meaning. Now, this is a low. A point where you have a bearish and a bullish candlestick signifies a low. Here also, a point where you have bearish and bullish candlestick signifies a low. This is also a low. This is a low. This is also a low. This. So you will clearly see that all those points at the bottom are called lows. Why? Because they have bullish and bearish candlesticks. This is a low. This is a low. And you have them. So all those points at the bottom, they are basically called lows. Where you have bearish and bullish candlesticks, they are all lows. You understand? Then the points you have at the top are called highs. Now, when it comes to trading in terms of analyzing the market, just like one of the things I told you, where you implement, you get to apply the Fibonacci. We'll do a little bit of technical analysis on this area here, from this point to this point. We'll do a little bit of technical analysis around this point so that you get to understand certain things that made us to take trade on this particular market. Now we have one thing we easily do on the chart is this. We make use of our Fibonacci. I mean, not our Fibonacci, we make use of our trend line. Now connect from the lows to the other low. So you see, all I simply did, I connected from this low to this low. So I connected my trend line. So I connected my trend line from this low to this low. Let me see if you're still with me. All right, good. So I connected my trend line from this low to this low. Now doing that, it helped me a lot to be able to identify the fact that this particular market is on a downtrend. Now, one other thing we would easily do is we would also connect the highs. So connect this high to this next high, and then we drag it across. Now, when we drag it through, we clearly would see that this particular market has broken our trend line, but then we'll still watch that. We'll still take a good look at this particular break, because sometimes it can break impulsively and drop. Now, what is something we actually want to look out for on this particular downtrend? When picking a downtrend, we just go straight to the character of that market. So let's go to the 4 hours time frame. So now when looking at a downtrend, we want to understand the character of this market. That is how we are able to make entries. Now, when we are analyzing what has happened in the market, we call that backtesting. You understand? When we are analyzing what has happened in the market, we call it backtesting. When we are analyzing for what will happen in the market, then we call it a technical analysis which means we are simply analyzing to predict what will happen in the market. Now let's go from what has actually happened on the market, which is backtesting. Now, in order to be able to implement trading or get started trading, things we need to see in the market. I know my analysis may go in a rush, but over a period of time, you'll be able to get it when I repeat myself again and again and again. Now, this is something we want to see. We want to see this kind of structure, which I would draw here. Okay, before I even do this, let me delete it. So we want to see a structure like this. We want to see price rallying to the upside, coming up. So this is like a significant move of an uptrend. Now, for us to understand that this uptrend is closing, we see a break of this previous low. So when we see that break, we want to see a reversal to the upside, and then that is the point where we want to take our trade. That is one. I will explain also. Now, like this one, we saw a drop to the downside, market broke structure, created a resistance, it broke structure, used our Fibonacci and dropped to the downside. Now you will not understand all of these things I'm showing. Let me do it in terms of analytics form. Now what we simply want to see in the market is this. We want to see one, market take out what we call liquidity. This is actually not the best example for this particular back testing, but then let me look for a very good example so that you don't miss out on what the information I'm trying to pass. Now, exactly, this is one very good example. Now, what do we want to see? Sellers are in the market, and then we want to see what we call a liquidity grab. Now, what is a liquidity grab? A liquidity grab is whenever we see price push out sellers. So let me try to still make it a little bit bold so that you see it. I actually want you to understand this thing. I'll try my best. Now, whenever we see price dropping to the downside, it's created a resistance. This is a resistance here. It's created another resistance here. But now, after this resistance was created, we got a break of structure. This particular break to the downside is considered as a break of structure. Now, after this break of structure happened here, what we want to do is we want to now pick our Fibonacci tool, which is this tool I set for you there. We want to pick the Fibonacci tool and then mark it from the swing high to the swing low. Where is our swing low? Our swing low is the low which created this push to the upside. So we've gotten one, which is, these are stated rules and you can write it down. If we don't see this thing in the market, we don't take any entry. We want to, whenever you get the record, you can do that. Now we want to see a break of liquidity being taken to the upside. That is the first signal we want to see in the market. Then we want to see a break of this market to the downside, a break of structure. Now when we get a break of market structure to the downside, we want to see price give. Can you hear me?
Yes.
Very good. So we want to see price give us a drop from our swing high to our swing low. We want to mark Fibonacci. So we mark our Fibonacci actually. How you mark your Fibonacci? You pick this, you see this circle at the top. You take it to that point where you want to mark it, or where you want to plot your level of resistance. So that is this particular point. You bring it here, you mark it there, and then you drag it. Now when you drag it, you want to drag it to the low which created this push to the upside. So you want to mark it to this low which created the push to the upside. Now we mark it here. You simply extend it. Now whenever price rallies to the upside, there are two levels which you see in all my videos I post that we use for our entries. The first level we use for our entry is the 0.618. You can see it here, 0.618. So this is the first level we use for our entry. And then, yeah. So this is the first level we use for our entry. We fix our take profits here. Now I always tell you guys I don't like taking profit at the -0.2 level. So that is the original place to take profits. But most times before market hits that point, it actually does reversals, and I don't like to be in the reversals of the market. Now, we had this first entry. Now, on this first entry, actually, you can see stop loss got hit on the first entry. Our second entry is basically above this one. So I will explain something now. This trade is basically giving us, what will we call it, a one ratio. Let's see. So the first one actually gave us a one ratio. Let's see. The first trade actually gave us 1 ratio 3.7, but then it hits the stop loss, which is nice. Then let's say we risk a $15 on that particular trade. We lose that $15. And then on this particular trade, a price got triggered at this point, and then we risk $15. We are going to make 4 times $15 basically. Are you with me? So on this particular trade, we will be making back the money we lost to the market. I will be making back extra of that particular money we lost on the market. So that way, it will help us to be able to understand, sorry, okay, times. So since we lost $15 on this particular trade, on this one, when you times it by 4, this is actually 1 ratio 3.8, which you can round to 1 ratio 4. Now on this particular trade, we lost $15 for instance. This second trade, we are not going to be losing $15. We are going to be recovering that $15 we lost on the market, and we're making an extra profit on it, which is basically a total of $60. You understand, on this trade, which is decent, a decent profit basically. So now that is for this particular one, implementing our strategy. Now, after that is being done, we can now look out for the next trade. What do we want to see? I would simply, okay, let me just delete this guy. So after this particular market hit take profit at this point, the next thing we are going to be doing is working with this particular guy here. Now, one thing we can easily see, we can see two break of structures before this particular break. We can see this point as our break of structure, and then we can easily see what we call our liquidity grab here. A liquidity grab is actually a liquidity grab is a point where we get our break of structure. There's noise in your place, bro. So a liquidity grab actually is a point where we get price being taken out to the upside. It's simply where price stops out people's entry. You understand? So when price stops out people's entry, it gives what we call liquidity grab. It takes out, we call it market takes out liquidity, and then it breaks to the downside, giving us break of structure. So now what do? We simply mark from this swing high to the swing low. So when we mark from the swing high to the swing low, basically, what are we looking out for? We look out for taking our entry. Same thing we did on that particular position trade is what we'll do here. What do? We pick our Fibonacci, we mark from this high, from this trade. The first trade hit stop loss, and the second one got triggered again. Now, the reason you must just follow this rule is this. Most trades may just trigger straight to the downside from this particular price point, which is 0.618, and then you will lose off that entry if you don't take it. So now on this one, 1 ratio 3.6, this one actually hits stop loss. But then the next trade did the wonder, which pushed us into profit. Now what can we see? We can simply see our stop loss at this price point, and then our take profit. Now this particular trade is a 1 ratio 3.4. Now we actually will be making back our loss, the trade we took a loss here, and then making back extra profit of 2.5 ratio basically. That way, if we're risking $15, we are still making 3 times of $15 with an extra. Now that is for this particular trade. Now, the same thing is what we did after that particular market gave us its reaction. So all of these moves, we actually cut these moves. Now, what are we seeing here? We see what sellers got into the market, but then price got taken out, and then we got a break of structure again, which played out at this point. And then what are we simply doing? We simply mark our swing high to our swing low, repeating that same action where we mark price at our swing high to our swing low. Now, what are we seeing? The same thing happened. Price got into our 0.618, we would have lost the first entry, and we simply still take our entry from this particular price point, from this point down to this particular price level, and we make profit on that. Now, this was the trade which you saw I made a lot of profit from, around about I think I closed about $800 on this particular market. From here to here, I think 800 or 1002 thereabout. Now, what happened? What made me take this trade? It's very clear. Now, I understood that we had a break of structure. Let me clear this chart. So, I understood we had a break of structure at this particular price point. It was clearly understood. And I also understood that we had liquidity grab at this level here. Now, what did I simply do? I simply marked from our swing high to our swing low. So I simply marked from this swing high to this swing low. Having done that, price got tapped in at this point, and then we started selling, placing ourselves from this point to the downside. Now our target was overall this particular low, but what happened? We could clearly see that we only just took our trade out of we just stopped our trade even while it has not gotten to take profit. We stopped our trade and allowed markets to start giving us the next direction. We were also able to still catch out of that particular next direction market gave. So I would explain what happened, what we saw also on that market. Now we are actually getting to see market new character, which I will explain. Now what happened? Come to the 1 hour time frame. That was where I was able to pick an entry. Now what did I see? We saw that price actually broke all of this structure, and if you should mark what we call our trend line break, if you should mark our trend line break, what did I do? Picking these two, what I simply did, I came here, I picked the trend line, then I came to this high here, I tapped my trend line there and marked it from this high, I marked it across to this next high and dragged it through. Now I don't want, if I should drag it to the top of this wick here, you will see what will happen. We will find out that there are wicks above here, all these levels. We don't want to see any wick, so we just simply adjust it to the highest wick we find around this price. So this now becomes a perfect trend line. So now that being the case, what happened? We simply saw that price broke above the trend line and started reversing. Now I didn't take any buy from all these points to the upside because I was still expecting that price could possibly still do its selling. But now when it gave us this break of structure, I simply went to the 15 minutes time frame, and that was where I understood that I could get in for a buy. So now what happened? The same thing we are looking out for is what happened here. What did we see? We saw a break of structure to the upside. Now I'm just going in straight to the teaching you the strategy we make use of, so you don't get to stress yourself doing other basic stuffs. You just understand the strategy itself, and over a period of time when you keep practicing it, you get it. Now we got a break of structure. Before the break of structure, we got what we call a liquidity grab. That means buyers got into the market from this point and started trying to push the market to the upside, but sellers took the buyer stop loss out and then continued the push to the upside. Now what do we simply do? We mark our level from the swing low to our swing high. What can we see? We see that price simply did its thing as usual. It came to the 0.618 level and then it bought. Now this was the original point for take profit, but because I understand what the market was doing, that was making a reversal, that was why I held to this high. I held to this high. So a student I actually was coaching yesterday or so, I gave him a trade. He took his trade to this high. But for me, I actually held my trade a little bit above that particular price point. And I'll show you where I held my trade to. So I actually held my trade around this particular price point, around here. Now, what did I see? I simply saw that this area of liquidity has not been, after price gave us a liquidity grab at this point. I actually was expecting market to rally back to this liquidity area, around this area, to give us an entry. But when we plotted our Fibonacci from this price point, which created this break of structure, let me mark the break of structure so that maybe it becomes a little bit clear. So when I did this plotting here, I saw that price actually did not give us the reaction I wanted by retracing from this particular level to the upside. If you look at it here, when we mark it from this point to this point, market did not get into my 0.618 level or 0.79 level. So it just reversed from the 0.50 level, and even before even getting to 0.50 level, then I understood that it was working with this Fibonacci at this point. I mean the liquidity grab that was taken at the break of structure at this point. Now that is actually the level that I am seeing this market coming to react to, which is this point. So if you can look at the market clearly, you would see something. I'm already on the sell on this particular market, and I hope to make at least a minimum of $60 to $70 per position I've taken. Now, what did I do? I simply got on the market, and I simply got on the market actually from this particular point. When I saw that price got into here, that was the point I was looking out for my take profits. So I just got in on this particular trade. Originally, my stop loss is going to be here, but I actually use my eyes to cut my losses basically. And then this will be our take profits. So this is the current trade we are on at the moment, and I think that is just that for this particular market, the volatility 25 index market. So the major things you just have to look out for in this strategy we use is you have to look out for one, liquidity grab. You have to look out for one, liquidity grab. Then you also have to look out for break of structure to the downside, liquidity grab, break of structure, and then you plot your Fibonacci from the swing high of the market to the swing low. And then whenever price retraces into the 0.618 level or the 0.79 level, you look at taking entry. So it's as simple as that, but very, very effective. And let me show you another trade I'm actually sitting on, and which is basically in profit, which is this particular one. What did we see? The same thing, the same concept. Now this trade, let me see. This market on my phone actually, this trade is actually on profit. Let me send it to you so you see what I'm talking about. Volatility 10. Yeah, volatility 10 is in good profit. Okay. Total, I mean 150, 169.
That's $169.
Yes.
That's good money.
Oh, well, you see the stick I'm sending you. I see as they look. I'll send it to you basically. So you can see the overall trade. So that was it actually. I was a little bit skeptical entering at the point where I originally was supposed to enter. Why? Because I was just taking my profits of the reversal. So when you're taking a reversal trade, it will actually confuse you a little bit from taking the original trade. So now what happened on this market? It's very clear. Now, what happened on this market was this. We got a liquidity grab here, meaning that sellers actually got into the market at this price point and they tried to push the market to the downside, but then buyers set in and stopped out the sellers that were selling at this point. It's like a kind of war fight basically. They stopped out the sellers that were selling at this point. They took their stop losses out. they always will say the market makers took their stop losses out, and that is just the best way we can explain that. Now after that happened, we got a break of structure to the downside. Now after we got a break of structure to the downside, what are we looking out for? Now using order block concept, you would see that on the video I posted last on order block. This is another block, and whenever we see price get into another block, we actually want to, it's a point of interest for us to take it sell. But then we now add this our confluence, which is using the Fibonacci tool. So now when we fix our Fibonacci, we drag it from the swing high to the swing low, and then that gives us our exact entry point and exit point. Now what can we see it did for us? We simply saw that with our Fibonacci, we were supposed to take our entry at this price point and put stop loss at this price point. But then based on this other block, I would not even want to take my trade from this entry into the level. So I'll be looking at taking my trade from this point. So then you can see price actually dropped massively from this price point, and it's currently at this price. At least by the time it gets to this point, I should be up around 800. So 800, 1000. So now this is what we are looking out for.
800.
Yes, so the thing there is this: you have to calculate your risk to reward. So whatever you're putting on the table, price actually gives you more than that. So now if I'm risking a percentage, 1%, I'm making 3.56%. Are you with me? So whatever I'm risking, I'll be making 3 times or close to 4 times of that particular percentage I'm risking on the account. So that is the current trade we have on this particular market. So now this trade is very simple and very straightforward, and nothing much I can say on this particular trade. I have a level I would simply call this is a level of trend line, and we could see market react at this point, but then it's just what it is. It's a wonderful trade we are actually in at the moment. So that's it, bro. I think this will be all for today, guy. This will be all for today. Any questions you might have, just do well to drop them. I would still try to explain. On this video, I would actually send it to you after this session so you can take a look at it and learn from it. Okay.